A skyscraper in downtown Chicago just sold for 87% less than what it was purchased for. And if you think this commercial real estate crisis doesn't affect you because you don't own office buildings, you need to understand that over 900 banks in this country are overexposed to these loans, and the delinquency rate just hit levels higher than the worst point of the 2008 financial crisis. I'm a real estate market analyst focused on commercial real estate dynamics, banking system risk, and how large-scale property market dislocations filter through to impact everyday people. Today, we need to talk about what's happening in the commercial real estate market, particularly in the office sector, because the numbers coming out right now are genuinely alarming. But we also need to talk about why this might not become the systemic crisis that some people are predicting, and that distinction is critical. All right, let's start with the transaction data because it tells a story that most people aren't fully grasping. A building at 525 West Van Buren in Chicago was purchased for $140 million in 2015. It just sold for $35 million. That's a 75% loss. Another building in Chicago, 175 West Jackson Boulevard, was owned by Brookfield, one of the largest real estate firms on the planet with over $900 billion in assets under management globally. They paid $306 million for this building in 2018. They just let it go for $41 million. That's an 87% loss. Brookfield ate a $265 million loss on a single building. When a firm of that size and sophistication takes a hit that large, it's not a bad trade. It's a signal that something fundamental is broken in the market. But we're not done. 4 Overlook Point, also in Chicago, sold for $148 million in 2012. It just changed hands for $6.2 million. That's a 96% loss. There are single-family homes in parts of New Jersey that cost more than this commercial building in downtown Chicago. And here's the one that stops people in their tracks. Worldwide Plaza in Midtown Manhattan, a 49-story office tower, one of the most recognizable buildings on the West Side. In 2017, a group of investors paid $1.7 billion to acquire a majority stake. Last month, the owners stated under oath in legal filings that they believe the building has little to no value. A $1.7 billion asset, essentially worth nothing according to the owners. Their anchor tenant vacated over 600,000 square feet, and Goldman Sachs and Deutsche Bank are currently fighting over the foreclosure. This is Midtown Manhattan, arguably the most valuable office corridor in America, and the owners are saying it's worth nothing. Every one of these buildings had a lender: banks, pension funds, commercial mortgage-backed securities trusts. Someone wrote a check for hundreds of millions of dollars expecting to get paid back with interest. So what happens to them? This is where it gets serious because over 900 banks in the United States are overexposed to commercial real estate loans. And the data on delinquencies is worse than most people realize. According to recent analytics, office CMBS delinquency just hit 12.34%. That's not just high, that's an all-time record. It's higher than 2009, higher than 2010, higher than the absolute worst point of the financial crisis. This metric has gone from 1.6% in mid-2022 to 12.34% today. That trajectory is nearly vertical. Here's the breakdown by property type. Office 12.34% delinquent, retail 7%, multifamily just under 7%, lodging 5.5%, industrial 0.62%. See that last number? Industrial is basically healthy. Remember that because it's going to matter. Now, nearly $100 billion in securitized commercial mortgages are maturing this year. Recent data confirms that more than half of them, roughly $57 billion, are not expected to pay off. Payoff rates have collapsed from above 80% in 2023 to under 50% right now. And $25 billion in CMBS loans are sitting past their maturity date with no resolution. Not paid off, not foreclosed, not formally extended, just sitting there. Zombie loans. Here's the mechanism that's creating this crisis. Most of these borrowers locked in rates at 3 to 4% during the cheap money era. Now they need to refinance at 6% or higher. Imagine your mortgage payment jumping 60 to 70% overnight, except you can't just tighten your belt and pay it because the building you borrowed against is worth 30, sometimes 50% less than when you bought it. You owe more than it's worth and the new payment is nearly double what you were paying. That's the trap. And the banking industry has had a strategy for dealing with this. They call it extend and pretend. Extend the loan maturity. Pretend the building is still worth what it was appraised at originally. It's been working for 3 years, but there's a clock on that strategy and it's running out. Let me show you which banks are most exposed. Regional and community banks hold 44% of their balance sheets in commercial real estate. Big national banks hold 13%. Over 900 banks currently exceed the regulatory concern threshold of 300% of Tier 1 capital and CRE exposure. If you have a checking account, savings account, or certificate of deposit at a regional bank, and about half of Americans do, your bank may be holding billions in loans backed by buildings like the ones I just described, and one bank almost didn't make it. In early 2024, a group led by former Treasury Secretary Steve Mnuchin wrote a check for $1.05 billion to rescue a single bank. $1 billion in emergency capital. That bank was Flagstar Financial, formerly New York Community Bank, and it was drowning in commercial real estate loans. They reported a $250 million quarterly loss. The stock crashed nearly 40% in a single day. They posted 8 straight quarters of losses. They had to shrink total assets from over $100 billion down to $87 billion. They basically amputated a third of themselves to stay alive. They finally returned to profitability in the fourth quarter of 2025. They survived, barely. And that's what it looks like when a bank is overexposed to CRE and the music stops. They made it. Not every bank will. Here's why extend and pretend is running out of road. Research shows that extended CRE loans now represent 27% of bank capital industry-wide. Every extension isn't free. It ties up capital, crowds out new lending by about 5%, and makes the eventual reckoning larger. 3 years of kicking the can means the can is now the size of a dumpster. Wells Fargo's CEO has publicly acknowledged the bank expects to lose $2 to $3 billion on its CRE office portfolio alone, with problems playing out over 3 to 4 years. And when these regional banks are eating losses on office loans, they don't just tighten commercial lending, they tighten everything. Home mortgages, home equity lines of credit, construction loans. If you're trying to buy a house or refinance right now and your regional bank is being stingy with approvals, this is part of the reason why. That 5% lending reduction measured by researchers isn't just commercial. It's hitting the housing market too. Now here's where this gets interesting, and this is critical to understand. If I stopped right here, you'd walk away thinking commercial real estate is finished. It's not. There's another side of this market that is booming so hard it's almost offensive, and it's the reason this probably doesn't become 2008 again. While office vacancy is sitting above 20% nationally, data center vacancy is at 1%. 1%. They are effectively full. The big 4 tech companies, Google, Amazon, Microsoft, and Meta, are collectively pouring roughly $400 billion into new data centers this year. The constraint isn't money, and it isn't tenants. It's that they literally cannot get enough electricity to power the buildings fast enough. Data center rents delivered over 21% year-over-year growth in 2025. This isn't doing well. This is a gold rush. And here's one that's going to surprise people. Remember the retail apocalypse? Dead malls, Amazon killing everything. National retail vacancy right now is 4.3%. That's the lowest since 2007. Grocery-anchored shopping centers are seeing the strongest valuations in a decade. Retail didn't die, it evolved. And right now it's one of the healthiest asset classes in all of commercial real estate. Industrial warehouses, logistics, distribution centers, essentially healthy. Same lending structures, same banks, completely different outcome. And the best performing property type in the country right now isn't data centers, it's not industrial, it's senior housing. 9.2% total returns over the last 12 months. Occupancy above 90% for independent living. Transaction volume up 61% year over year. Senior living facilities are quietly outperforming everything. Here's what all of this means. This is not a commercial real estate crisis. This is an office crisis happening inside a data center boom, a retail recovery, and a senior housing surge. Same industry, completely different realities. And that distinction is everything because the sectors that are strongest, data centers, industrial, retail, are also the sectors most capable of absorbing losses in the broader system. The sector in crisis, office, represents about 15% of total outstanding CRE debt. Painful? Absolutely. Concentrated? Yes. But is it large enough to take down the entire system by itself? That depends on one variable. Right now, the average commercial real estate loan is refinancing at about 6.24%. At that rate, the math doesn't work for most office borrowers. Their buildings simply don't generate enough income to cover the higher payments. Banks can keep extending, but that runway is shrinking every quarter. There's a threshold. The major analytics firms generally agree that if CRE borrowing rates drop below approximately 5.5%, a critical mass of these distressed loans become refinanceable. The buildings aren't worth what they were, but the payments become survivable. Above 5.5%, the defaults keep accelerating, and the wave of forced sales keeps building. We're at 6.24% right now. The Fed has cut rates multiple times, but here's the catch. CRE loans aren't priced off the overnight rate. They're priced off the 10-year Treasury, which is stubbornly sitting around 4 to 4.25%. So the gap between where we are and where we need to be is real. It's not insurmountable, but it's real. That gap is the knife's edge we're sitting on. What is the government doing about this? The Fed issued guidance that basically gives banks regulatory cover to keep extending and modifying loans as long as the borrower is considered creditworthy. Recent stress tests showed that all major banks could survive a scenario with 30% CRE price declines, though regional banks weren't included in those tests. Congress introduced a bipartisan bill offering a 20% tax credit for converting old office buildings to residential. There are now over 70,000 apartment units in the conversion pipeline nationally, up from 23,000 in 2022. Those conversions could actually help with the housing shortage in a lot of cities. So there's a scenario where the office crisis becomes a net positive for the housing market over time. The government's playbook is essentially buy time, convert what you can, and hope rates come down enough before extend and pretend collapses under its own weight. Here's my assessment. 2026 is most likely the peak year of distress, not the beginning of a downward spiral. Leading analysts believe this year will be the peak and the market begins normalizing in 2027 and beyond. CRE investment activity is actually projected to increase 16% this year. Money is coming back into the market, but most likely is doing a lot of heavy lifting in that sentence. If rates don't cooperate and extend and pretend runs out of road, then the peak hasn't happened yet. So what does this mean for regular people? If you bank at a regional or community bank, understand that your bank may have significant exposure to commercial real estate. That doesn't mean you should panic and pull your money out. Deposits under $250,000 are FDIC insured. But it does mean you should be aware. If you're trying to get a mortgage or a business loan and you're experiencing tighter lending standards, this is part of why. Banks that are nursing losses on CRE are being more conservative across the board. If you work in commercial real estate, property management, or related industries, understand that the office sector is going through a structural adjustment that's going to take years to resolve. But also understand that other sectors are thriving. For investors, this is a bifurcated market. Office is in crisis. Data centers, industrial, certain types of retail, and senior housing are doing well. You can't paint the entire asset class with one brush. And for policymakers and economists, this is a test case for whether targeted distress in one sector can be contained without spreading to the broader financial system. So far, the answer appears to be yes, but we're not out of the woods yet. $2 trillion in debt, record defaults, buildings selling for pennies on the dollar. And somehow the answer isn't that commercial real estate is dying. It's that it's splitting in two. One half is being buried, the other half is being reborn. We're sitting here in early 2026 watching the funeral and the birth happen at the same time. The data says this probably doesn't become 2008 again, but probably is a word we've learned to be very careful with in real estate. That's the breakdown of the commercial real estate situation and what it means for the financial system and the broader economy. Thanks for watching. If you found this analysis helpful, let me know in the comments. Tell me whether you think office buildings ever fully recover or if remote work has permanently changed the demand picture. And if you want more content breaking down real estate market dynamics, banking system risks, and economic trends with no hype and no fear-mongering, just data and analysis, subscribe to the channel. I'll see you in the next one.